Hi everyone! Before we start, I want to remind you all to smash that like button and hit that subscribe button. Now, let's get into it. A stock market crash is a sudden and dramatic decline in the stock market. The Dow Jones Industrial Average is an index of 30 stocks traded on the New York Stock Exchange. It's one of the most watched indexes for its ability to measure how well a company's shares are performing. When the Dow Jones falls, it means that these companies' shares have dropped dramatically in value. The Dow Jones can be used to measure how well a company's shares are performing, so when it falls, it means that these companies' shares have dropped dramatically in value. This can happen for many reasons, from a bad economy or political instability to technological changes or natural disasters. What causes stock market crashes? A stock market crash is a sudden, dramatic, and often unexpected decline of stock prices across a significant cross-section of a stock market, resulting in a substantial loss of paper wealth. The most likely causes of stock market crashes are as follows. 1. Commercial bank failures. When a commercial bank becomes insolvent and cannot repay its depositors, the resulting financial instability can cause stock prices on markets where the bank was a significant institution to decline rapidly. Several commercial bank failures in recent history have caused international stock markets to experience substantial declines. 2. Increase in interest rates. An increase in interest rates can cause an overall decline in the stock market, particularly for individuals and businesses with large amounts of fixed income assets, such as mortgage debt or consumer debt such as credit card bills. 3. Trading halts and circuit breakers. Trading halts are periods during which all trading on exchanges is temporarily halted. Circuit breakers are periods during which trading is limited to a particular period. These rules are enacted to avoid extreme price fluctuations during market crashes. 4. Events that trigger sell-offs. Major political events like war, terrorism, or political assassinations may cause large portions of the market to react with fear and sell their holdings. Since many people are invested in the stock market through retirement savings and 401ks, these events can cause large swings. 5. Stock market panic. People may react to economic or political crises by selling their shares of stock at a high price, which could lead to panic selling and ultimately a bear market. How to prepare for the next stock market crash. A stock market crash can be sudden and dramatic. Still, there are ways to prepare and stay ahead when it eventually happens again. The first step in preparing for the next stock market crash is diversifying your investments. You should invest in assets not correlated with stocks such as real estate or commodities like gold or silver. This will help you avoid losses when the next market downturn happens. The next stock market crash is inevitable. It is not a question of if but when. Prepare for it by diversifying your investments to include assets not correlated with stocks. Real estate, for example, is an excellent investment as it tends to rise in value when the economy is doing well or when interest rates are low. The second step is to start looking for long-term investments, not ones you can make a quick profit from, like trading penny stocks. Trading penny stocks is a risky investment and one that should be avoided. Trading penny stocks is dangerous because there are no regulations. The prices change quickly, often before the transaction even happens. This can lead to a loss of money and time. Short-term investments like trading penny stocks are a quick, easy way to make money but also can potentially lose you a lot of money. Long-term investments are more stable and can give you a reliable return on your investment. They take time to make and sometimes seem slow, but the long-term payout is worth it. Finally, you should be prepared for a market crash by having savings or investments that will provide enough money to live off of for at least 6 months if the economy goes sour. Financial advisors and professionals have always counseled consumers to have a rainy day fund. This financial buffer is usually in the form of cash, securities, or other assets that can be quickly accessed for income. The idea is that this fund will provide a sufficient amount of money to cover living expenses for a while, if their regular income becomes interrupted by an economic event such as a market crash. Most financial advisors agree that having at least 6 months of living expenses in a rainy day fund is a reasonable recommendation. However, the Financial Industry Regulatory Authority, FINRA, regulation limits these accounts to $250,000. If you have more than this in your account, you should take it out and put it into something safer, such as stocks or a bank savings account. In addition, some financial advisors advocate for having a 6-month cash reserve of 1 year's worth of living expenses due to the risk that market crashes pose to consumers. The 6-month amount will provide a cushion against unexpected economic events. Still, more importantly, it will always be available if an individual's regular income becomes interrupted by an economic event. The future of the stock market and how you can profit from it. The future of the stock market has always been a mystery. However, as technology progresses and AI becomes more prevalent in our daily lives, it will be easier than ever to predict the stock market's movements. This is because AI can provide traders with predictions about what to do next. It can also be used to automate trades, so traders are not risking their money anymore. Let's explore this topic more next time. Thank you for listening. Remember to hit that subscribe button and destroy that like button.